So like we are starting with the budget development process. Fine. So what we are going to discuss right now is budget development process. So specific budgets and their development will be discussed later. However, the process for developing each budget is similar. The main steps in the budget development process are as follows. First, the budget guidelines are set and communicated. Yes, this is done by the company's management who are the one who are entitled to prepare the budgets. First, what they'll do is they'll set some guidelines, and then these guidelines they'll communicate to the peers or the juniors or subordinates. So setting the guidelines and communicating them may be done by a budget committee, and you know budget committee is nothing but the one which has board of directors and senior management in them. So budget committee is the one which is responsible for preparing budgets. They look after this budget activity. The initial budget guidelines govern the preparation of the profit plan. Yes, because if you set some guideline initially, that helps for the preparation of a profit plan. That means you can estimate your profits. Information considered in the development of budget guidelines includes the general outlook for the economy and the markets. Yeah, see where you are going to start your business, where you are going to set up your factory or whatever. You should also take those things into consideration, because when you make a budget, you make all the estimates. That means you have all the things beforehand on the paper, and there you also, when you forecast something, that means when you make your estimates, you consider economy, even the markets even in which you're going to operate. Okay, because that will decide how much revenues you can generate. Because if it's a booming economy, you can have a different figure when compared to an economy which is not that booming. Fine. So the figures may be different. Now, strategic objectives and long-term plans, expected operating results for current period. Since a budget for the coming period is developed toward the end of current period, before the current period has been come. Yeah, we make it like before. For the next year, we make beforehand, isn't it so? Specific corporate decisions for the coming period. Yes, upcoming period we make all these budgets so that we can take some good decisions. Response to environmental requirements and short-term objectives. We have to consider these even for making the budgets. So now the next point is initial budget proposals are prepared by responsibility centers. There are a lot of responsibility centers in the company, like cost center, profit center, investment center. Just I'm naming some of them. Centers are specifically dealing with all these particular figures, all these particular things. The agenda is to, so let me give an example. What cost center does? Cost center's job or the more prime focus would be to reduce the cost, how the cost can be minimized for every activity. So you know all the centers play a crucial role, because all these centers what I've discussed with you on whatever they are dealing with are a part of your budgets. That means if you want to make a budgeted income statement, you have cost of sales, then you have revenue center which takes care of revenue enhancement or how you can generate more revenues. Revenue is a part of budgeted income statement. So all this initial budget proposal by the responsibility centers. Okay, so each responsibility center manager prepares an initial budget proposal using the budget guidelines, and since guidelines are given to them, as well as his or her own knowledge about his or her own area, as I explained you right now. Then negotiation, review and approval. Yes, if like they make, then negotiations happen. They first make a draft, submit it to the committee, who is headed by board of directors, CEO or whatever executives. Then they go through that. Budget should be prepared, and those budgets what they prepare should be attainable, achievable. So wherever negotiation is required is done. Review, this particular senior executives they review and then they approve the budget. And revision, see wherever it is required, like with the passage of time, you should be like the thing should be dynamic. Dynamic is nothing but with passage of time, when changes are expected, you can change things. You should not put keep yourself lot rigid with budget preparation. Like I'm speaking about a flexible budgets also. In flexible budget, we not only restrict ourselves to some point. Like this is, suppose if I have to make 10,000 units, then I make a budget for 10,000 units. That's called static budget. But if I think no, I can make more or less, I keep myself flexible. So I make flexible revisions are nothing but wherever, like one plan is finally adopted, but if there is some change which might advisors, the advisors are given to the management regarding some things to change, they have to do that. Reporting on variances, of course, this is one of the most important points. Like you make budgets, fine. Budgets are nothing but your financial plans. For example, if I speak about revenue or revenue budget, or if I make, let's say I make a overhead budget or material budget or whatever it is. So I make my overhead budget whereby I fix my like according to budget, my overhead should be $10,000 or my expenditure should be $10,000. This is an estimate. Actuality can differ. In actuality, I can get $12,000 as my expense or 8,000. If I get 12,000, that is unfavorable. If I get 8,000, that's favorable. So I should do the variance reporting. I should compare the budgeted with the actual. Okay. And then we variance reports for further future decision making, because if the expenditure has surpassed what you have budgeted, then it's a serious matter and you should rethink. You should think about it, how you what you can do to reduce your expenses. Budgetary slack and its impact on goal congruency. Slack I've explained yesterday itself. Budgetary slack is nothing but you keep yourself very flexible. And I've also given you the, just a second. I've yesterday explained you about the budgetary slack is nothing but overestimation or underestimation of certain things. You always try to overestimate expenses and you underestimate your revenues. Why? Because you want to keep that cushion with you. And that can have an impact on your goal congruence. Yes, goal congruence is nothing but all having the same goal. That's nothing but aligning the goals of two or more groups as used in planning and budgeting. It refers to the aligning of goals of individual managers with the goals of organization as whole. Sometimes the performance of an individual manager unit will benefit from action from an action the manager takes, of course. But the overall performance of the company is either not impacted at all or it may actually be negatively impacted. An individual division manager may reject a capital investment that would improve the company's total profits. Yeah, sometimes some decisions are taken which are not good. So we cannot blame the manager for that because they have their own estimates, and always estimates won't be correct, isn't it so? See, out of their experience, what they have, less blunders are expected from them. But sometimes when they reject something, thinking that that is very, see, sometimes what happens, suppose my manager is considering, we are considering Kenya as a country to set up our factory, and that Kenya is African nation whereby we get some minerals which are required for my project, and that my manager rejects it. He says no, we are not going to go, we cannot go afford to start a company in Kenya. A lot of the cost would be very high or something like that. And let's say the Tata company has bought has set up their plant there, and they are doing very well. So that decision of my manager is the one which really is not appreciable, correct? See what happened to Land Rover and Jaguar. Okay, those are loss making, but Tata converted that into profits initially. Okay, so situations like these occur because the goals of individual managers are not aligned with the goals of company. So company strategic objectives are communicated to individual managers as the part of planning and budgeting process. When things are informed to the managers, they kind of cautiously work and they see like their decision should not affect the organization. Excuse me. Yeah. So so we were here. Yeah. So, however, like a hazard in budgeting is that it may lead to behaviors on the part of managers that benefit them, all the departments, but not congruent with the goals of companies. So they only look forward for their departments and make some budgets which kind of are some unrealistic ones, like they overestimate revenues, underestimate expenses, or like they do budgetary slack. Okay, so it shouldn't be in such a way that it should not be in line with the company's like goal, and it should not impact the goal congruence. Okay, so they shouldn't make budgets in such a way that it would be like impacting the future decision making. Okay, fine. So when managers are evaluated according to whether they meet their budgets, managers who develop the budgets, they are going to be accountable to meet, may build in budgetary slack in order to make sure their budgets are achievable without any risk of failure. Budgetary slack is a difference. I already explained you what is budgetary slack. On the positive side, budgetary slack can provide managers with a cushion against unforeseen circumstances. But see, always it's not good. Like it's like that is questioning their sometimes what happens if they overestimate and underestimate things, and that's like you're not exactly on your target. You're overestimating or underestimating. That's a issue. So on positive side, budgetary slack can provide managers with cushion against unforeseen circumstances, which can limit managers' exposure to uncertainty and thereby reduce their risk aversion. The reduced anxiety about risk may help the managers make decisions that are more closely congruent with the goals of senior management. Okay. So the point is the reduced anxiety or fear about the risk. Like, yeah, they think that there's some kind of risk to the activities what the company is performing, and because of that they underestimate or overestimate, and then matches. See, if there's a risk and I consider the risk element, everyone also will be of the opinion. Yeah, you have considered the risk element, and they also would be the ones who will not be questioning me. Why did I overestimate or underestimate certain things? Why? Because risk element was there, and they know that. So that again brings the congruency in their thoughts and my budgets, what I make. However, budgetary slack often creates more problems than it solves at times. So for example, budgetary slack can misrepresent the true profit potential of the company and can lead to inefficient resource allocation and poor coordination of activities within the company. As a result, planning inaccuracy spreads throughout the company, of course. Furthermore, if sales are planned too low, yeah, that means it underestimates your sales and underestimates your profits. Okay, and like possibly leading to product shortages because budgeted demand has been understated. The advertising program and distribution expense budgets may be planned incorrectly, and the cash budget might be inaccurate. So if you sometimes overestimate, underestimate things, other things also get impacted, and other budgets also get impacted. So what you can do, the best way to avoid the problems caused by budgetary slack is to use profit plan as a planning and control tool, but not for managerial performance evaluation. If company does use the budget to evaluate managers, it would reward them based on the accuracy of the forecast. That's what, see, the ones who are very accurate with their budget preparation are the ones are rewarded. Okay, they'll get bonus. Then come the responsibility centers and controllable costs. See, responsibility centers are nothing but the ones which I've already explained you. Controllable costs are nothing but the ones which can be controlled with a decision making. Non-controllable costs are something which you don't have answer to. Okay. So let's see, controllable costs are costs for which manager has the authority to make decisions about how money will be spent. Non-controllable are costs that are ordinarily controlled at a higher level in the organization, such as manager's salary or bonus. So manager's salary or bonus is controllable, but not by manager. The senior most management will do that. So manager's salary will usually be assigned to his or her responsibility center's budget and will appear on reports comparing actual results to the budgeted amount. But manager should not be held responsible for it. Yeah. So allocation of indirect cost. See, I am speaking about indirect expenses, that is overhead. Okay. So how will you allocate overhead? I will explain you. So standard costs used in, so here we are. Yeah. So allocation of indirect cost of organization, like let's say administrative overheads, these are indirect cost. Manufacturing overheads, these are indirect cost. So the allocation of these costs of the organization as a whole may be another non-controllable cost. Of course, see, you have answer to many of the questions. Let's say electricity bill. This you can control. Why? Because it's a variable, semi-variable cost. The more electricity you use, the more the bill. The less you use, the less the bill. So you can try to save, and you can try to save the electricity bill, electricity, and unnecessarily, like there may be many times whereby unnecessarily you will be like the fans or the motor would be switched on. So you can kind of control that. But office rent, factory rent, you don't have an answer to that. So that's not under your control. What the other party is charging is what you need to pay. So since that indirect cost may be allocated on, see, so I would give you the direct example. What you can do is you can take the factory rent, which is say, let's say $10,000. You can allocate that with one of the base. That is either on the basis of machine hours. This is the allocation base, or labor hours. See, wages, you are paying $10 for 1 hour. Raw material, 15 per unit. All this you can find per unit. You can get a quote, but overheads are always lump sum amount, total amounts. You cannot find that per unit easily. So for finding out per unit overhead cost, you need to like allocate that with some base, so that you can get a per unit overhead cost estimate, and that would help you to ascertain the per unit cost of the product. Okay, so I'm speaking about absorption costing, which you'll be learning in the future. So here machine hours, like say the machine hours 1,000 hours. 1,000 hours the machine is working, or labor are working 1,000 hours. Let's say. So like so $10 per machine hour is nothing but your factory overhead. Okay, hope you understood. So all costs should be included on some managers variance report and identified as the responsibility of the manager on whose report they appear. If an expense is classified as non-controllable on a given manager's budget reports, then that expense should be included as controllable expense on the report of higher level manager who makes the decisions that affect that expense. Yes, because as we discussed right now, as we discuss right now, some costs are like the ones which are controllable with the lower level management, and like some costs they cannot control. So that like manager's salary we discussed right now. So the manager cannot control their salary themselves. So senior management has to do that. Okay, so they have to take decision regarding that. So all costs should be controlled by someone. That's the topmost the highest management level can do that. Whenever no one is responsible for a cost, the uncontrolled cost creates great risk for the company. So it is also important to recognize that fixed costs and indirect costs are not always controllable, and variable costs and direct costs are not always controllable. So not always uncontrollable and not always controllable. Yeah, depends. So many of the fixed costs you don't have answer to that. You cannot control that, and many of the variable costs are not always controllable. Just a second. So some things are not always some things are always not uncontrollable, and some things are not always controllable. The nature of each cost will vary according to its characteristics, and each cost should be analyzed to determine who controls it. The distinction between controllable and non-controllable cost is especially important if managers' performance evaluations will be dependent on their meeting budgetary targets. If other performance measures are used to evaluate managers, the distinction between controllable and non-controllable cost may be less important. Yeah. So if you are judging the performance of the managers, that means if you want to evaluate. So if other performance measures are used to evaluate managers, so like the distinction or difference between controllable and non-controllable cost will maybe less important. So you are not judging the performance on based on these two factors, but other factors. So this would be less important. So regardless of whether or not managers' evaluations are affected by their meeting budgetary targets, if they meet it, they are good performance. If they don't, then they are not good performance. Understood, fine. Now, standard costs used in budgeting. See, what do you mean by standard cost? Standard costs are nothing but predetermined costs or estimated costs for the future. That means you have set some standard. Based upon that standard, you have set some cost. So when standard costing is used in manufacturing, see, when you make a product, the product is the product can be made with what? So this is profit. How you can get the profit? Profit you can get when you subtract revenue, when you subtract cost of sales from revenue. What is cost of sales? Raw material, labor, and overheads. So now what happens? You know that all these factors to be considered for getting this. So now I'm discussing about estimated profit. So for estimated profit, you should have estimated revenue. For estimated revenue, to get that estimated revenue, you have to spend. For that, you should have estimated cost. And cost is a combination of all these things, which we estimate. So now we are speaking about standard cost. That means we are estimating per unit cost of something. So I'll tell you the difference between standard cost and budgeted cost. Standard budgeted actual. You know, standard cost is always per unit wise, per unit estimated cost. That means you're going to pay $10 to labor for making 1 unit, let's say. That is standard cost. Budgeted is always in terms of total. Okay, so it's not easy for you to get per unit estimate of some overheads to make budgeted costs. Okay, and actually is what you really incur when you start the manufacturing or any kind of process. Okay. Now the standard input is the quantity of input required to produce 1 unit of output, of course. And standard price is the price company expects to pay for 1 unit of an input, as I said you. So standard input is nothing but how much material